where we could not fill a half hour, and now I've got to cut stuff to actually get this down to an hour or less. So this week, just opening up, we're going to talk about the ICE IRS data sharing breach in court case. Just going to mention it, but it just immediately made me think of what's going to happen in a couple of years. Was your data shared by the Internal Revenue Service? You might be due compensation. So I can't wait for those ads. 42,695 people's personally identifiable information was shared, and that was outside of the agreed upon amounts in the Memorandum of Understanding. We'll talk about that. So those of you that need to find me, scan the QR code. It'll populate into your phone all of my useful contact information, and we'll be happy to reach out to you and return any calls or help you any way that we can. So we've signed the agreement with the venue. So the 13th Annual International Tax Conference will be October 26th, 27th, 28th, same week that it's been for a while. Be returning to New York City, same venue as last year, down on 26th Street, and a great Chelsea neighborhood. We'll look forward to seeing you. I do not have all of the speakers lined up, so I don't have registration open yet, but I should in the next week or so. Rita is returning for boot camp on Monday, the 26th, and she'll do a couple of other programs over the next 2 days. If you're a speaker on international issues and you'd like to join us, send me an email, tell me what you'd like to speak about, and we'll go from there. I'm happy to report for the third week in a row. Mike, no, I'm trying to sign a deal with Holiday Inn across the street to have a room block. So for those of you that have been paying attention, third week in a row, we actually have numbers through today. That's a great thing. We had a couple of holidays. We had the late IRS startup. So the data was perpetually 7-8 days behind. Now we're caught up to date. That doesn't mean we're going to like the numbers that we're going to see. No real change this week in identity theft. It's disappointing that tomorrow we will be a full 22 months behind in processing individual identity theft cases. All the things the IRS is complaining about, all the things that National Taxpayer Advocate identifies as a problem, and maybe all the things our national groups push on fly-in days is the processing here, and these need to get processed way more quickly, within 60 or 90 days. It shouldn't take us this long. Form 1040s, 3 weeks if it's electronically filed. Paper returns are through January 2025. They're all original returns. They're still processing January of 2025. There's been no movement in 5 weeks. Amended returns submitted through November 2025 are being processed. Oops. Ever one of those days? Business return processing timeline. There's been no movement on 1120s or 1041 returns. They're still processing those January returns. The only thing I can think of was there a whole pile of paper returns filed? Just no movement here. Why are we taking so long? I didn't hear any feedback about dropping 941 processing times. Please let me know if you feel one way or the other, because I don't know how valuable it is to speak about these things. We had a 100% increase this week in the time frame for processing forms 2848, forms 8821. They increased from 1 day to 2. I think 2 days is still quite reasonable to be turning around these processing forms. W7 applications for ITINs are processed currently. No delay. 8802 residency certificates, they've not moved. They are still processing the December backlog. Form 1045 and 1139 have not moved either. We want to set the expectation for any clients that you need to file those refund claims for. So submissions for Form W4, obviously if it's online, they have a social security number and it's a U.S. entity, you can get that number issued almost immediately. However, if you need to fax it in for an entity organized outside the United States, or a person who doesn't have a U.S. tax number, Faxed submissions are coming back in 8 days. We call in a week and get the number over the phone. We have power of attorney. We do that the best we can. Paper submissions are coming back within 30 days, they say. I would not send them anything on paper. I would have a power of attorney, submit it via fax, and follow up to make sure that it's been processed and get that number. Individual correspondence, those random responses or letters you mail in, they are through November for individual correspondence, June for business correspondence, and anything else they are through August. Same thing. That's pretty abysmal that it's at least 90 days back so that they can send you what? A letter that says we need 90 more days? It's insane. Electronic filing is the fastest. Paper is a bad idea. E-file good, paper bad. Same thing with checks. We're seeing e-file forms processed quickly. Their stated goal has been 5 days. We're seeing them done 1 day, not 1 or 2 days, not 4. And I-10 applications, residency certificates have varying turnaround time, but all in all, post-COVID, they're pretty acceptable turnaround times. So we're going to start to have the next 2 months, I hope. I'm going to give you tax refund trends to the extent they make sense and are going to add some value here so that we understand what's going on. Certainly after tax season, the fact that 100,000 more returns were filed or something is of minimal value. But I think these numbers, at least this week, next couple of weeks, are super, super valuable. Taxpayers are receiving larger refunds. I'm giving you this information because your clients may say, well, what about? I don't know anybody that gets the average refund. But if you're comparing this year to last year, the average refund was $2,476 from the start of the season through February 13th, 2026. Comparing that to the identical week, not the day, right? But they go by those processing weeks. It's a 14.2% increase over last year. What's the driver of these things? Well, OBA is probably the driver because payroll withholding was not adjusted for all of these additional credits and deductions that we have available. It's too early, though, to determine what this is going to look like for the tax season. And the reason is that we don't yet have those path refunds factored in here, right? So refund averages typically increase as the season progresses. Earned income credit, child tax credit, additional child tax credits. The first returns aren't even processed by law until after April 15th. I think March 2nd is a date I've frequently seen cited as when the first refunds are going to hit the accounts. So we're going to continue to watch the data at least through mid-March, if not through April, to see where refunds go. What are the drivers? The 3 big lies, or 2 of the 3 big lies. No tax on tips, no tax on overtime. These things are landing on Schedule 1A, along with the additional over age 65 deduction and the interest on automobile purchases. Now, this was an interesting statistic because we have nothing to compare it to. 14.9 million people have filed a Schedule 1A. I couldn't get a better breakdown because it would be interesting to know, are half of those people over the age of 65, for example? What's the impact of some of these other deductions? Because the information we had from prior to this filing season, like 4.9% of workers get tips and 8 or 9% receive overtime. So the expectations about how many of these returns we need to file were not like everybody was going to need to do one. So seeing 14.9 million filed already might indicate fraud, might indicate misunderstanding. It might just tell us who the early season filers are, especially if that number tapers off dramatically as we go through the season, right? $49.9 billion in deductions have been claimed. Interestingly, the IRS wants to be a digital agency. They want to see more and more and more impact. I couldn't get a number other than year-over-year number, but this week through tax season through this week over tax season through last year, same time, 42% increase in the number of folks going to the website. Now, of course, 41% of that could be, where's my refund? I don't think it is. I think like COVID, more and more folks are just being driven to the website to do things. And this is something that the IRS has wanted for years. They have wanted to be a digital first service business. And here we go. Maybe we're getting there. So that 42% number they think is great, and it signals public awareness of new deductions, right? Again, we don't know what pages they're going to, but we're just assuming. It may also be placing a strain on the digital infrastructure. I would imagine TIGTA is going to let us know. But as far as I know right now, I'm not aware of any reports that I can't get through on the website. I've heard from practitioners on Roger Nemeth's Facebook group, Tax Help Software, that there may have been some difficulties in uploading signed digital powers of attorney through my Tax Pro account, but I'm unclear of that. We didn't experience that here. We probably have at least one document a day that gets uploaded, but I'm just sharing what we're hearing because sharing is caring. All right. What else is going to happen here? We've talked before about the workforce and processing constraints that are going on. 25% workforce deduction from last season to this season. They were not able to hire the majority. I think they hired 50 seasonal people, 50, out of 5,000, some large number like that. So we enter 2026 with a sizable tax return inventory from less people, less IRS employees last year, the reorganization of people leaving, work being reassigned, and that 6-week shutdown. So they had things in inventory. We saw that with the numbers I showed you with their inventory. Things haven't moved since January. I wonder why. Because they're still slogging through all of that back work. All right. And of course, they had to focus on getting OBA ready, implementing it. My tax software, CCH, doesn't do a Form 8829 yet. Someone else said Lacert doesn't do 8960 yet. These are things that we need working now. I don't know that that's a software vendor issue. I think that that's coming from this whole hurry up and wait and rush for implementation. Now, this was interesting. Across every major category, IRS processing volumes are trending downward from last year's levels. It's because none of us want to prepare tax returns anymore. Early season fluctuations can happen from year over year, but since it's happening across all of their monitored metrics, the IRS is a bit concerned. 5.1% decline in returns received from us. Well, no kidding. Software wasn't ready. CCH updates once a week, so I've had plenty of returns ready to go, sitting here waiting for the software. Form 8283 wasn't available till last week. We had wage earner returns that could have gone out pending this. Another thing might be, depending on the systems within your office, all sorts of people are itemizing now because the changed SALT cap if they earn under $500,000. And we've had many people say, I don't keep track of my charity. I've had younger people say, I should keep track of that. So we're back to educating people. And that may be part of the problem why things are sitting on hold and not getting out. You can see here a nice graphical number of returns received, returns processed. Interestingly, how many e-file returns are below returns received? That's probably a combination of folks mailing in those returns before e-file opened and prior returns which cannot be run through e-file. So we said that there was a prioritization of the backlog. More complex returns are being filed earlier. Of those 14.9 million returns with Schedule 1A, no idea what criteria the IRS is using to scan them. We've seen no messages, no notices. They might just be banging them out and processing them. So we don't know. So if the double-digit increase in processing continues past February, this may indicate systemic delays rather than the early season, we're getting up to speed, e-file started later. If they don't catch up, it's going to be like this the whole year. They're not going to catch up. So we want to watch these weekly numbers because this will be problematic. People will be unhappy. All right. so where are we going? The early filing season paints a picture of larger refunds, stronger engagement with the legislation, the IRS website, even though the IRS is operating under extreme operational pressure. But we're going to watch that background because we have those 5% decrease in return processing. So we're monitoring this for you. I think most of you, we beat up Schedule 1A. I decided not to talk about any Schedule 1A issues this week. Certainly, if anybody's having any trouble, we have recorded videos or email, call. We're happy to try and talk you through some of these problems. I get a lot of Facebook chats these days, too. The next 4 to 6 weeks of filing season data will be decisive in letting us know whether the IRS will deliver on its processing obligations, or whether taxpayers and practitioners need to prepare for a season defined by delays. So this was an article I read in Tax Notes. I can't share that article with you, but because it's a paid subscription, but it was a very interesting analysis, and I'm able to share what I gleaned from it with you, just not the actual notice. So this week we've got a couple of new things happening in Washington. Senate Finance Committee introduced the bipartisan TAS Act, Taxpayer Assistance and Service Act. I had to read that twice, right? Because I thought, they're saying Taxpayer Advocate Service. They're not, right? This is just a bill not related to that. But they combined the annual recommendations that came from the National Taxpayer Advocate with some other standalone bills related to modernizing IRS procedure and administration. Now, I'm going to preface this by saying, with what money? They've taken so much money away. I don't know how they're going to build this. These were things they were trying to build on their own. So this bill proposes to fund online account upgrades, increase preparer standards. I'm going to talk about that too. Establish minimum competency standards for paid preparers. Now, we've been down this road. I've been doing tax returns since 1987, right? I did 86 returns in January of 1987. And this has come up 3, 4, 5 times. Whenever there's some big crisis, we should go ahead and regulate the half of the industry that isn't regulated. And of course, what's happened is Congress has said no. We don't want to set the infrastructure. We don't want to hear the blowback. We don't want to hear about the increase in the cost of the average individual doing a return. 1955, when the IRS tested stopping doing tax returns in their offices. Now, let me get that straight. You could walk into a TAC and an IRS employee would prepare your tax return for you if needed. They tested that in Kansas City, Missouri. So the Block brothers ran a bookkeeping business, and they decided they were going to test tax preparation. They learned that they were onto a gold mine, and hence came along Block. But we're going to talk about the General Accounting Office released a paper that I gave you a copy of. We'll talk about that. This bill would purport to protect fraud victims from indefinite IRS scrutiny. So remember, if you're a victim of fraud, the IRS catches it, they give you that taxpayer, that identity protection, IPIN, and I think you get that permanently. And right now, the tax court cannot hear, it's a court of law, not a court of equity, so it doesn't hear cases relating to refunds. You actually have to sue in the Federal Court of Claims. Donna or someone's going to correct me in the chat, but I think that's right. And they're going to change that. So this would be interesting how this worked as well. So TIGTA, Treasury Inspector General for Tax Administration, issued a couple of reports this week. And I have one of them right here, and it's in your folder in the handouts. And if you're watching this on YouTube, subscribe to the channel. You'll be able to see in the comments the link to access these handouts. So TIGTA reviewed nearly 6.9 million taxpayer accounts that were locked with the deceased indicator between tax years 2022 and 2024. I would have rather they did this completely outside of COVID, but they didn't. So accuracy was very high, but they still had enough errors that it was a problem, because sadly everybody dies. So they looked at 6.9 million accounts. It's one of the things with AI, right? Are they going to not have to audit a sample, but actually audit everything? They found that 99.8% of these affected accounts were locked or not locked correctly. But even 0.2% adds up. 13,500 living taxpayers somehow were reported as not living. And there's no date of death on the Social Security death index, right? That's updated monthly, sent to the IRS. Somehow these accounts were locked. 13,500. It's not 135. That's not a handful. That's not everybody with the name of Smith. That's a lot of people. More concerning might be that 31,000 people weren't locked. So that's potentially 31,000 Social Security numbers to be taken advantage of. These were folks that were deceased, and for one reason or another, the service did not lock those accounts correctly. Well, what does this mean? When an account isn't locked with a deceased indicator, living taxpayers cannot file a return or receive a refund without first authenticating themselves with the IRS. We all know it's a long time on the phone. It's a trip downtown. Your practitioner generally can't do that for you. You need to do it. You need to resolve it. Unlocked deceased accounts can create openings for fraudsters. It wasn't mentioned, but I would think if I'm a surviving spouse, that could be problematic for me, that person, my identity can be stolen. My spouse, the deceased spouse's identity can be easily stolen. The IRS expects to fix these errors during an update in January. No update on whether the update was successful, but this is something that's out there. Okay, so Frank Bisignano, a New Jersey guy, right? Head of the Social Security Administration, now IRS CEO. He did not go through Senate approval or Senate hearings, confirmation hearings, or a vetting or a vote, right? He was already vetted, pre-vetted because he ran Social Security. You can run two departments. That's great for us. So he testified on March 4th about how OBA implementation is going, the problem with sharing immigrants' address information with the Department of Homeland Security, and there's been a drop in criminal investigations into abusive tax schemes. Now, Mark Dabrowski will tell you that CID chooses their own cases. There's 2,500 armed CID agents. So they generally have a high conviction rate, a high success rate, because they choose what cases they're going to work. All right, so in the State of the Union, and I will not cover the State of the Union at length here, I'm just going to talk about a few things. The president highlighted tax breaks under OBA, higher refunds, Trump accounts, and there's hope that there's going to be a second reconciliation bill to deal with some regulatory reform, Medicaid funding, maybe the premium tax credits, but reading the blogs, Politico, and some of these places, it seems that they don't have the votes to get this done before the midterm election, given that House Republican majority isn't really interested in Medicare and Medicaid cuts, especially in an election year. Now, retirement savings match, this actually isn't new. It's coming in under Secure and OBA, but we haven't talked about it because it's a 2027 item, this retirement savings match. So there's a Pew Research study. I didn't put that in the handouts. If you want it, email me. I'll send it to you. The administration would like to provide $1,000 annual retirement savings match for the federal government. Isn't that amazing? That's a common number for President Trump. I think he thinks $1,000 is a lot of money to some of us. This initiative is going to target the 56 million private sector employees who currently lack an employer-sponsored retirement plan. There are some scary numbers out there, not mentioned here. How many people retire with under $50,000 of retirement savings and are plan to live on Social Security? So they're looking to remedy this disparity between private workers and federal employees by providing access to the same type of retirement savings vehicle. So what's going to happen is that there's a change under Secure 2. So it's called the Savers Match. right? Right now we have the Savers Credit. Now we're going to have the Savers Match. So the Savers Credit, you'll remember, is non-refundable, and it's 20%, 30%, or 50%, depending on your income, of up to $2,000. Of course, it's a non-refundable credit, so many people get $200 or $500 by putting money into a retirement plan, an IRA, a 401k at work. We're probably going to see more of these because many 401k plans were required to have the automatic enrollment, and many states, New York, Oregon, California, have savers programs. If you have some number 3, 5, 10 employees, you're required to offer a retirement plan, and if not, you're going to use the state plan. So we're going to see more and more people on the lower end of the spectrum contributing some level of money, qualifying for a credit. The problem is, if I don't need that credit, if my tax is already going to be zero or near zero, I may not get full benefit of that credit. What's the guy to do? Well, Savers Match is this new credit that's coming in already approved, not a proposed law, coming in under 2027 under Secure Act 2.0. Savers Credit is that old credit that's gone out. And essentially, I feel like I'm missing a slide here. They're proposing that first, that $1,000 is going to go directly into the retirement account from the federal government, $3,000. And then mechanism not mentioned, criteria not mentioned, other than it seems to suggest new people that are first going to open a retirement account. No regulations, no guidance, no framework. Secondly, though, we've got this Savers Match out there, which is a dollar for dollar match on the money, and it's not delivered as part of the tax refund or tax liability. It's paid directly into the account. So probably this summer, we should start talking about some of these 2027 items, if only so you can help clients plan for 2027. Okay, so that first image of the guy with the microphone looks a lot like Billy Long, right? But Billy was actually a hero in this mess. IRS violated the Internal Revenue Code approximately 43,000 times. So let's talk about what they did. One of the biggest data breaches in history. So the IRS and ICE entered into a memorandum of understanding in 2020, where basically they would share certain information about folks that had a felony conviction and a final order of deportation. In other words, we're looking for these guys and we can't find them. You're going to be the person of last resort. If you have their records, you're going to give it to us. We're going to put them out of the country. Seems innocuous, but that whole give an inch, take a yard, take a mile. All right. So the law was pretty clear. The memorandum of understanding was pretty clear. But watch some of the things they did here. So there's a court case, and it was found there was a temporary restraining order put in place last November. No more data sharing. And now the court has ruled you're done, right? There's problems here. So the MOU set up the data sharing. However, it was complex. There was some conflicts in it. And of course, wink, wink, nod, nod. Tie goes to the government, not to the taxpayer. So what happened? Well, first, ICE asked for some numbers starting during Commissioner Long's very short 7 or 8 week tenure. And he said to them, that's not what the memorandum of understanding says. So simple, a guy who was there, new on the job, said, no. All right, so Colleen Collar-Coatley, I couldn't find who appointed her, whether she was a Republican or a Democrat appointee. Last week issues an opinion that the other 42,695 shares of data violated the memorandum of understanding, violated the law. Nina Olson came out and said there is no known precedent for tens of thousands of violations of federal taxpayer confidentiality. So what happened? ICE received 47,300 addresses in August alone. The court says 42,695 of these should not have been shared. So around 4,600 names met the criteria. Those people we're looking, we can't find them. So I mentioned this November court injunction. It blocked the data sharing between the two parties. And the government, of course, is appealing this to the Court of Appeals for the DC Circuit. But right now, there's no sharing. Now, what's the justification versus what was the reality here? Department of Homeland Security said they needed the information to identify individuals who were here in the country illegally, locating violent criminals, neutralizing terror threats, scrubbing the voter rolls. We always go back to voting. Identifying public benefit usage, okay? The court said, regardless of all of those objectives, it's illegal. You can't share that data, right? 7216, you can't share that data for purposes of other than a tax return. So what were they allowed to do? The code establishes explicit protocols before the IRS can disclose any confidential information. The agency has to provide the IRS with the information they want. The IRS verifies the request and comes up with the last address they have, whatever information they have. The IRS discloses releases the confidential taxpayer address. All they were looking for. Well, under testimony, Chief Risk Officer Dottie Romo confirmed thousands of requests contained critically incomplete address entries. Among them, failed to provide, unknown address, Nana, Nene, whatever N-A-N-A is, no street address, no numbers, or the addresses of jails, detention facilities, and prisons, but without the street address. That one might not bother me so much. If the person's current residence is a detention facility, maybe you can get away with that, but they shouldn't. So one egregious example was Don't Care, and 12345 is the zip code. So the city of Don't Care, 12345. A large number of these things, they put all zeros as a zip code placeholder. And failed to provide was stated in the address field of thousands of requests. Now, we don't have any context here. So does that mean I had incarcerated someone and they got freed before we had all the detail? Was there a language barrier? We don't know. But that does seem a little sketchy, right? Failed to provide. So this is a visualization of it. 4,605 requests were compliant, about less than 10%. Not a good thing. Not a good thing at all. So unprecedented scope. Law requires specificity, right? They're allowed to share this data, but in this super, super narrow, that's basically, we know who this is, we know where they were, we wonder where they are now, can you help? So for the meantime, it's blocked, but there's an appeal in underway. All right, so oversight of paid return preparers, not one of the most exciting things some of us want to hear, but let's take a quick look. And I'm going to do a longer version of this. I didn't want to keep you awake by telling you who some of these things are. So we all share exactly one obligation, that we're supposed to have a PTIN. Beyond that, obligations vary about what you have to do or not do. Not with respect to return preparation, but with respect to regulation licensing. So credentialed professionals with full IRS representation rights, enrolled agents, CPAs, enrolled actuaries, enrolled retirement plan agents, if I didn't say attorneys. No credentials are required, $18.75 and a dream. And you too can be a paid tax preparer in 46 states without problem. New York has a small little licensing thing. Maryland has a registration system of its own. The states of Colorado, California, and Oregon have formal education and requirements that you work for someone else who signs off before you can enter the industry. So we know who a paid preparer is, anyone compensated to prepare a return. We have this program that came into existence when the RRTP went away when they lost the lawsuit, and its annual filing season program. And essentially, I take a 6-hour test, a 6-hour class, a certain amount of CE, and a 100-question open book test every year. And I get limited representation rights. I can represent a tax return for someone whom I prepared the return. I can represent them in exam. A little bit. My understanding is that most AFSPs have great difficulty getting the IRS to understand who they are and what they are. That's a problem. Ghost preparers are individuals who complete returns for clients without providing a valid PTIN, illegally bypassing the ID requirements. We used to, even before the days of TurboTax, we had ghost preparers back in the block days. When we were the only game in town to do e-file or do a refund anticipation loan, we had people come in with handwritten returns. And, when you saw 10 or 20 returns that handwriting was the same, information was the same, but they were unsigned, you started to realize this is somebody working at home at their kitchen table doing returns. So what happened back in 2014? 2011 is when this starts, 2012. And then by 2014, we had a court case. So Karen Hawkins was director of OPR. If you remember, Karen told us we were all going to lose our licenses, right? She was going to make a lot of changes to the Return Preparer Office and the Office of Professional Responsibility. So prior to 2011, no regulations for unenrolled preparers. A PTIN was even optional. You said put your Social Security number on the bottom of the return, but no regulation, again, outside of Oregon, California back then. So 2011, they issued rules requiring registration, testing, continuing education, the RT-RP program. Key here is it was all administrative rules by the IRS. There was no mandate by Congress, no rule, no regulation, no law that said we delegate to the Internal Revenue Service creating this infrastructure. Wasn't there, didn't exist. So a number of constitutional organizations sponsored 3 individuals that were unenrolled for a lawsuit, and one of them was Miss Lovin. And they sued the IRS saying, you can't do this. You can't make me take a test. You can't make me get a PTIN. You can't make me pay a fee. Blah, blah, blah. I have the right to do a return. And the courts agreed because the IRS lacked statutory authority under 31 USC Section 330. Note that the tax code is Title 26, right? So Title 31 is financial crimes. The one thing the court agreed is that you're right, they can't regulate you, but we think it's a pretty good idea that the IRS be able to track who's doing a tax return and know who they are. So the PTIN part stayed. Everything else was found to be outside their authority. And Congress hasn't corrected that, right? In 12 years, 13 years, Congress has 12 years, Congress has not said, Loving is wrong and we're going to create a law to rectify that. So the IRS can only regulate tax practitioners. The majority of paid preparers are unregulated. And in fact, the only way for the IRS to stop you from doing a tax return is either A, they convince the Department of Justice to sue you and enjoin you from preparing tax returns, or we see this in a number of criminal indictments against tax preparers. You'll see where it says John agreed to stop preparing tax returns for a fee for life, right? So otherwise, it's the only way to stop. In fact, when they lost Loving, Karen had made a comment. They had taken some EAs and CPAs they had disbarred. They took away their PTIN. And what happened was she made the comment publicly, we may have to give PTINs back to a few people because they got them on one thing and get them on the ability to take away preparing a return. This was the most surprising thing I saw, and this is why I wanted to share this with you. So the quality of tax preparation and common errors, this blew my mind. National Research Program, I'll explain what that is in a minute, that data reveals that returns prepared by paid preparers have a higher estimated error rate than self-prepared returns. Now, one thought that didn't come up here is how many of those TurboTax returns that say self-prepared on the bottom really were? Not calling out TurboTax here, but that's typically what we see. What's the NRP? And then we'll talk about what they released. So the IRS utilizes the National Research Program. Maybe you've had those before. That's where they do an audit that says, bring the birth certificates for the kids. Prove to me that's your mailing address, right? They verify, prove to me you're married. They verify every single line on the return. Purpose isn't revenue raising. The purpose is statistical gathering. What are people doing wrong? What do people misunderstand? Where are people cheating? Where are the gaps? So it measures the difference between taxes owed, taxes voluntarily paid. It's completely randomized. It's comprehensive, supposed to be statistically valid based on places, people, all those good things that some actuary says work, some data scientist. We're looking to identify error problems, and it's going to be used to develop policy and in some cases, maybe enforcement. So error rates, common errors found in IRS undercover visits. This, without telling you who, some people that we talk about and that some of you know have been involved in doing this study. So failing to report non-W-2 income, cash tips, right? These are undercover visits. So you know, they don't ask you about other income. You say, oh, I got $4,000 in tips. Did that get reported? Omitting business income entirely is an error. No 1099, no reporting. We know that's a whole. Claiming an ineligible child for the EITC. Hey, my sister's kid, she's not claiming her because she's in prison. I've got her social security number. Missing preparer signatures, missing PTINs, calculating the incorrect refund. We all do that occasionally, right? But so that's very subjective as to what's the incorrect refund. But these errors contributed to billions of dollars in improper payments to taxpayers. The overstated liabilities mean you lose benefits. Understated liabilities trigger IRS adjustments and penalties later. All right, so the IRS deploys a layered strategy from education and outreach to automated detection. If you're on social media, you see some of our folks that do what I would call, I owned H&R Block offices for 13 years, so I'm not looking down on anyone when I say storefront retail type businesses. You know, sometimes I'm like Jimmy the Grunt from The Practice, right? Where I'm in a storefront, just in and out, in and out. People come, they sit, they wait their turn, we solve their problem. So the IRS has some of these filters in place, but we saw a lot of warning notices published this year. Hi, you've made a whole lot of errors on schedules A, C, E, and certain credits. We've seen Jason Dowtry is talking about he just did 2 audits back to back in Ohio and Louisiana for preparer audits for due diligence. And what I haven't heard about IRS office staff visits in a couple of years, I think maybe since before COVID. What I find interesting is the people that get these notices right underneath, and none of my clients have any problems because they haven't come in to tell me there was a problem. And you think, well, did you just not know what you were doing? Did you make a legitimate mistake? Or more importantly, was the client lying to you? And I think a lot of that is the client gets caught. They don't come and tell you, oh, I had a problem. They just disappear because they know they're caught with something they're doing. So the Dirty Dozen list that comes out every year from the IRS, that alerts taxpayers to abusive schemes. And also we have the Security Summit that tells us how to protect ourselves and what schemes are coming through there. And we all need to follow due diligence. There's some great videos, including Jason's video from a couple weeks ago. It's available for free. The IRS has a range of penalties. By the way, Jason's video free on the YouTube channel. If you're an IRS PTIN holder, we can give you credit for it. You just have to take a 10-question quiz. The Internal Revenue Code provides a range of penalties to get you to behave. Everyone says, I don't want to lose my license. 6694A, unreasonable positions, $1,000 or 50% of your income. 6695, failure to provide a copy of the return, furnish it, or put a PTIN on it, $65 each. 7206, fraud or false statements, $100K, ouch. 7207, knowingly providing false returns, $10,000 a pop, ouch. So what are some opportunities to improve oversight? General Accounting Office, Electronic Tax Administration, Taxpayer Advocate Service, Treasury Inspector General, and ERSAC have repeatedly called for reform, but you don't hear practitioner groups calling for reform. Some of the national practitioner groups are not in favor of statewide national licensing or reform. So there's two ways this is going to go. Either the IRS is going to finalize a service-wide strategy that's going to ensure consistent treatment, but they've got to be careful they don't overreach, or Congress is going to give the IRS specific authority to establish standards and security requirements. Now, that would be interesting too, just like with your credit card vendor, right? Do you have to pass IRS security testing on the computers you're using to do returns on your office infrastructure? I think that would be great, because it would be interesting to know where the data breaches are coming from. You do this with your credit card vendors, right? Once a year, they want to do that testing. So if you want to see this stuff, this is in a general accounting office report that also gives a whole bunch of background. That's why I said I'm going to do a longer video on it at some point. So by all means, that's in the handouts. If you want to take a look at it, it's in there right now. All right. So car loan interest reporting relief. This is really bizarre that this came out, and I didn't realize the length of some of the requirements that OBA put on the lenders, because we tend to focus during tax update and other training. Okay, your client is eligible for this. Here are the requirements, and then either there's going to be a 1098, there's going to be some other document. Here's what you're allowed to do. Here's what you can't do. But how about this? Banks and credit unions are pushing back on the 1098 VLI requirement. All right, so we know the deduction is $10,000 up to. The estimate is that 6 million loans qualify last year for cars with final assembly in the U.S. that were financed. 35,800 businesses are responsible for issuing 1098 VLI. Now, that's an estimate, but put it within 5,000, right? That means 30 and 40,000 have to do this. Loan origination date during 2025 or later. They're going to report the whole interest. We can deduct up to $10,000 of it if we qualify. Vehicle needs to be U.S. assembled and meeting certain criteria. And interestingly, it came up in one of the coaching groups. The VIN number did not come back as assembled in the U.S., final assembly in the U.S., but the guy had the Windows sticker, and it clearly said it was assembled at some plant in Tennessee. So what do? Well, we went and reread OBA, and guess what? You can rely on the Windows sticker. Now, as I said to the person in the coaching group, what are you going to do when you get that letter? He said, I'm taking a power of attorney. So we'll see what happens. All right. Now, lender reporting obligations, high level. They're required to verify the loan meets certain vehicle deduction rules, which includes personal use. How do I know if it's personal use or not? They have to file the 1098 VLI. They have to calculate the interest, and if it's under $600, they don't issue the document, and then they have to issue the documents. Some of this requires granular data that lenders and even the originator of the loan, the car dealership, may not have. So this is going beyond typical reporting. Typically, make the comparison to a student loan or a mortgage. We report the interest on the loan. We don't care about anything beyond that. It's up to you, the preparer, and the taxpayer to calculate the taxes correctly, deduct things correctly. It's a straight reporting requirement. So what's going to happen is we're going to have inconsistent data, higher error rates, and borrower confusion. I have a client who is a teacher, and she has a new child. So she bought a Lincoln something, whatever their SUV is. It's a 2022. She bought it through her credit union in 2025. The credit union sent a letter that explained the deduction, explained they don't have to issue the 1098 this year, and said, here's the information about your loan. You and your tax preparer need to figure it out. It's a 2022 car. It doesn't qualify. This is a large credit union, and they weren't able to filter out something as simple as what year is the car. Quite interesting. Some of these other problems I have not I had not considered. So financial institutions lack access to some of the data. They have no reliable information on if it's a personal use vehicle or not. They have no data on the gross vehicle weight. It's not in lender documents, and it's not in most of the dealer documents that would go to the lender. The final assembly location is not standardized. Contrary to popular belief, the VIN is mostly right, but there could be vehicles assembled here with some level of final assembly that are not. The VIN doesn't reflect that. And then the biggest concern expressed was negative equity. So another negative equity is I owe $5,000, I owe $10,000 on my current vehicle, and they give me $8,000 on the trade-in. I have $2,000 of negative equity. That needs to be taken into account in the interest on the new loan. So there's a structural mismatch here because the data the IRS requires is not currently being captured by the dealer, the manufacturer, and the borrower. Can they put it together? Probably. It's not technology, but it's structural. We're not collecting that data. Nobody expected to collect that data. Now, the dealers, I'm going to show you who's saying it. The dealers are saying it is impossible to figure this out. Well, I think you could have a checkbox, right? Is it impossible? Worksheet, checkbox, data entry into a computer. You can figure it out, but it's not something that they had planned on. The proposed regulations say negative equity is not considered part of the deductible loan, and you need to exclude it when calculating the interest. So let's go back to my example. I have a $2,000 negative equity. I borrow $20,000 for my new car. $2,000 over 20, 10% of the interest won't be deductible, and you need to reduce the 1098 by the 10%. In addition to that being confusing, if I'm your tax preparer and I see that difference, I'm going to ask why, what's wrong. We're going to end up calling there. It's a little silly. So in practice, negative equity is commonly rolled into the cars, and nobody tracks it, nobody cares, because at the end of the day, they're like, are we willing to loan this person that much money for this vehicle? Now, there's two organizations I'm going to mention in a minute, and one of them is the National Credit Union Association. They think that this should be removed completely, right? Why are we even arguing it? Just remove it. So here's what the industry is asking. So first, we have two groups. We said the credit unions, the bankers. American Banker Association wants Treasury and IRS to take two actions. First, extend Notice 2025-20-57, the transitional relief that we have, which said if you don't issue the 1098 and you do your best to issue it, they list a couple of ways, a letter, the website, the statement, you're okay with it. They now want that to go through 2027. Well, doesn't this law end in 2028? It's very interesting. They want to align it with regulations in Section 6050AA. The final regulations and definitions should conform to this so that lenders report only what they know, not what they have to guess or have to go out and find. Credit unions have a slightly different suggestion. And you would think the two would align what they're asking for so that we don't have this back and forth. So America's credit unions, which is like the American Bankers Association, their national umbrella organization, is asking for a broader set of accommodations because they want to recognize the unique challenges that very small institutions have. There's a credit union in Brooklyn, Grow Brooklyn. They just opened their third branch. I spoke there a couple of years ago, and we were talking about retirement plans, and I said, and you can open an IRA right here in the branch. And the people from the credit union in the back of the room going like this at me because it's too much regulation. It would have been too costly. So they actually referred out something that you and I would think is as simple as opening an IRA at the bank. All right, so small institutions do have other challenges. So first, the credit unions would like to see a gradual rollout of reporting requirements over multiple years. Although I would think if you're going to update your computer, you're either updating your computer or you're not. Good faith data collection should come with a protection. We're going to share similar to the ABA. We're going to share what we know, not what you need. And they also would like the negative equity rule removed. So, they're closer in alignment here than they're not. But be that as it may. So my opinion is report it like a 1098 and let taxpayers sort out deductibility, just like a 1098 from just like a 1098E from a student loan, just like a 1098 for mortgage interest, just like a 1098T. Here's what you paid. The rest of it is on you. That would make everybody happy, I think. There are a subset of practitioners I call form fillers. Well, it got reported, so you're going to deduct it anyway. I don't know. But that's just my opinion. And I'm entitled to an opinion. Last section coming up. All right. And we are monitoring this for you, and we'll tell you if anything changes. So briefly, this was hilarious to me. Erroneous recovery rebate payments. So we have a large number of non-resident alien clients here. So for all of them, they did not get rebate recovery credits, and we did not put them down on the return. They didn't get the advance payments. We didn't put them down on the return, right? The $1,200, the $600, the $1,400. So in early 2024, early 25, we got all sorts of letters. You didn't claim your check. We think you owe you a check. We didn't respond to them. What happened? They started mailing $1,400 checks to people. Thank goodness most, but not all of the clients got in touch with us. And we said, you know what? No. One of them was terrible because this is what's happened to him. We mailed it back with certified mail, not mine. Two things have since happened this year. First, he got bills last year for $1,400, and we had to write back. We actually went to a CDP hearing. We had to write to them first and tell them, I never got the money. Look at my transcript. I never cashed the check. Look at your records. And we filed a CDP hearing to also simultaneously protect him. By the time it was time for the CDP hearing, they said, okay, we've already resolved it administratively, so we're going to cancel the meeting. I looked at the transcript. It's clear. So that's good. But then what did he get in the mail this week? Because he wrote to me and said, are you out of your mind? They told him that his check was stale dated, and if he would like a new one, what form to fill out. And you can't win, right? Even after, and then we saw this TIGTA study this week. So what did TIGTA do? They looked at the directive, they looked at the errors, and they talked about what can be done to recover from this. 300,843 people who received a payment in January of 2025 should not have. So these were the American Rescue Plan Act 2021 $1,400 payments. So ARPA was enacted, creates the $1,400 payment. December of 21 was the deadline for the IRS to issue advance payments. In 24, there were like 1 million people they wanted to mail checks to. I think that was the number. And out they went. And we told everybody, don't cash those checks. When we saw them hitting, actually a benefit of Roger Nemeth's software, we saw them hitting the transcripts. All our non-resident aliens and our U.S. people that live out of the country, we have a power of attorney so that we can monitor things, because probably I'll see it before they do. We started seeing these $1,400 payments hit the transcripts, and we're like, oh no. So everybody got a communication. If you get it, I wasn't wrong. They are. You're not entitled to it. Some of them cashed the check anyway. I relieved them of the, how can I put this nicely? I have relieved them of the burden of having to deal with me because they didn't listen to me. And then, all right, so back and forth now. So they looked at the 12, I talk about here. All right. So $1,400 for individuals, $2,800 for married jointly, and $1,400 per payment, per dependent. ARPA permitted ITIN holders to claim the rebate recovery credit for dependents if they had a valid Social Security number or ATIN. Here were the phase outs. All right. Who was excluded? Non-resident aliens, dependents of other individuals, estates and trusts, folks that were deceased prior to 2021. In January of 25, the IRS issued 1.2 million payments because they want to be good government. An oversight in interpreting eligibility requirements and the use of incomplete data, whatever that means, resulted in 300,000 people receiving $448 million in payments. 25% of the whole thing. That's a pretty bad error rate. Yeah, and over half of those checks went to non-resident aliens. Simple test. Because you don't have to worry about any of it. If it was a 1040 NR, you get ngats, as my mother would say, ngats. All right. 225,000 of those payments went to non-resident aliens. IRS's analysis failed to exclude them. Another 68,000 people had already received the payment, resulting in duplicate payments. That one is kind of okay, maybe, but all right. So erroneous payments were caused by incomplete data. I don't know what that means. Failure to include key eligibility requirements. Yes, they didn't scan for, did you file a 1040 NR where you claimed as dependent, right? They didn't scan for those things. All right. So what are they doing? 29,000 of the payments were recovered early through voluntary repayment. I think most of those were my clients, or undeliverable mail. The IRS is now formally trying to collect this money. Generally, they have 2 years from the date of the erroneous refund to try and collect it. What they'll end up doing probably is doing offset refunds to try and collect the money. Critical limitation: they can't lien or levy this money. Because they were an IRS error, the IRS cannot use standard collection. They can't do a federal tax lien. They can't do a levy authority. So that's interesting. What are they saying? We should have told everybody to keep the money. They can only use refund offset. This is similar to the rules when they refer a case out to a third-party collection agency, right? They don't have levy or lien authority. Okay. So at the end of the period, they have a 2-year window. If the debt remains unpaid, the IRS has to close the action. Now, this would be interesting. This would be something to watch. However you feel about the money, you want to make sure your client's rights are not violated here if they try to collect outside of the 2-year period. And you want to watch maybe the filing of other documents, right? When do you want to file other refund returns if a statute is about to expire, if a collection period is about to expire? It's expected they will issue a 1099-C for that debt. All right. And these are the scale of these errors. So save the date, please. If you would like to join us in New York City, you can come just for 1 day for the boot camp. We can come for all 3 days. You can come just for the second and third day and skip the boot camp. We'd love to see you. I promise that in the next 10 days, we'll have some of this finalized and up on the website. Thank you all for joining us. I hope you have a fabulous weekend and are not like me here working. All right. Real quick, let's look. Are there any interest? Nobody put a Q&A. Bill is saying requirement for a first lien on the vehicle financed. Yeah, I think we knew that. I think we also knew the HELOC. Okay. Oh, thank you, Samantha, for telling me that you have the 8829. All right, everybody. Have a great weekend again.